What's going on, traders? Welcome to the channel. I'm John. That's Groot. We trade options here. So Amazon, really expensive stock, and I'm going to show you how you can trade basically the notional value of $326,000, but only using a couple $100. The setup here is going to be a put credit spread in Robinhood. Let's dive in. I'll show you the setup. All right, traders, we are in Amazon. AMZN is the ticker symbol. Now I want you to note a couple things. The trading price for Amazon right now is $3,236.15. Now, say you wanted to own just 100 shares of this stock. You would literally have to put up $323,000 to basically control 100 shares. Very inefficient, right? Amazon, good stock, fine. Maybe it's bad stock to some people, but bottom line is, I mean, to have 100 shares, you're basically controlling almost the value of a house for some people. Let's look at this though. When you're trading options, you can be more efficient. As an example, we're going to utilize something called a put credit spread. And what this is in a put credit spread, you end up having a series of puts. And as long as the stock does not trade below that value, the strike value of the puts that you have, then you will be earning income based on that over time. So right now I'm in I'll do this again so you can see it. When you go here, you go to trade AMZN options, boom. And then once you're in there, there's a few things you need to look at on this setup. For one, we need to go to put. And the other thing too, generally speaking, it shows you the front month, like the closest set of contracts. May 28th, that's actually today. We don't want that. Go out further. So typically, let's just say I'll go to like June 18th for now. And that's about 22 days from now. This is the monthly contract in June. I have my puts, and what I want to look at is the cost per share. We want to go lower. And to set up a put credit spread, there's two portions to this. There's a sell and a buy of a put. So I'm going to start with the selling point and portion here. And we want to go lower than the current value. So right now this is trading at 3,232. And you go basically lower. So let's just say if I go about 100 points lower, 3,150 or so, let's say. So I'm going to select this. And then what I'll do as well is you want to have a buy portion. So when you do a buy, you're basically adding protection to this. You're risk defining your spread and your position. So as an example, you can see here, right now I just have the put sell. So I shorted a put at 3,150. Let's open this up more. And you can see my max loss is massive. So I'm putting myself at a big risk in case Amazon maybe goes to zero between now and then. The likelihood probably pretty low. However, they will not let me do this since my buying power is much lower. So we want to make this more efficient. So now you're going to hit buy. And then you want to negotiate the spread. So for example, you see my short strike is 3,150. If I go 10 lower, so this would be 3,140, that's 10 points between the spread, right? So I'll add this. And you can now see at the top, I have my two setups of a spread. I actually see a credit that I would get paid if I took on this trade. But now Robinhood does a really good job explaining like the profit and loss diagram. So as an example, it's saying, hey, as long as we do not exceed the strike points that you have, then you are looking good. Your break even price here is 3,147.50. You can see that right here. And then as long as I'm above that at expiration, I'm looking good. I'll collect this max profit here at $250. Otherwise, my maximum loss. So remember how before my max loss was like $300,000? Well, now it will only be 700 to 750 or so, depending on that. So I basically risk defined my trade, which is really nice. And then you can see the break-even point. So Robinhood did a really good job adding this in here. Now, as an example, let's just say I don't want to put up $700 for collateral. Maybe I want it to be under $500, because this would say, hey, to even take on this trade, Robinhood's saying you need to have $750 available to trade. Let's do this. I'm going to tighten up my spread. And if I close this out here, boom, and I'm going to go to 5-point wide spread. So see the 3,150? Well, I'll just define it now at 3,145. So that's my put purchase, and I'm going to add that here. So I'm selling the 3,150, I'm buying the 3,145. That's a 5-point spread. Now I collected less credit and premium. However, my max loss much lower, and then also my break-even point has changed too. But keep in mind, now I'm using less than $400 to put on this trade and basically control 100 shares of Amazon at a defined level and price. So if I feel really good, I think maybe Amazon is going to go higher, or at least not go below the strike prices I have, then this is a trade I could take on and basically collect income. So this is just one form of income trading. Put credit spreads, pretty powerful, but when you do them the right way and you're utilizing proper risk management, these can be a very good strategy to use. So this other video explains how I set up an actual Amazon trade with Tastyworks if you're interested in that. Otherwise, this is my short and long-term strategy here, and it's going to explain it in detail.